Hello everyone, how's it going? In this video, we're going to talk about SOFI Technologies trading under the ticker symbol SOFI. As one of the most volatile and bullish stocks during the peak of 2020 and 2021, SOFI has definitely been on most traders' radar. As one of the more developed fintech enterprises out there, SOFI accomplished something that most fintech companies either couldn't or didn't bother to do. They have a bank license. With that key document at hand, SOFI stands as one of the most fleshed out and comprehensive fintech companies that can actually replace traditional banks. With that being said, the most recent stock performance of SOFI has followed the market trend overall, which is down. Nevertheless, many people are still interested by eventually buying SOFI because it seems to have a very good potential. In today's video, we will take a look at SOFI and try to work out if you should be buying its shares. If you appreciate my content, please consider to drop a like, comment, and subscribe to my channel. Also, please check out the links in the description section, as every help is greatly appreciated. SOFI has been targeting the $8 level over the past few days and finally settled around $7.41, decreasing by 0.7% compared to the opening. And overall, it has recovered at a decent rate given the circumstances, increasing by more than 53% in the past month. There have been a lot of speculations around the company, suggesting that 2023 could be a year of recovery and even new highs, but I think that we're way too soon in the year to tell whether it's going to be successful or not. But what I know for sure at the current stage is that the market is currently believing that the company's share price has fallen too far too quickly. So this is probably the beginning of a slow recovery back to its former levels. Simply put, high and low interest rates could both benefit SOFI in different perspectives. And because the market has tagged SOFI as a growth stock, an eventual decrease of the interest rate could increase its market cap, whereas an increase or the continuing high interest rate can increase its profits. So nevertheless, I believe that SOFI is trying to move on from the bearish phase to start a positive cycle. SOFI is a fintech company that aims to become a virtual bank for users seeking more functionalities, flexibility, and competitive fees. As people's needs change over time regarding how and where they want to have access to their money, SOFI identified the opportunity to do better than traditional banks, offering scalable and consistent quality of service to its users and clients. Unlike many fintech companies offering different parts of what a bank functionalities are, it's worth pointing out that SOFI tries to bring all the services under one umbrella platform in order to optimize the acquisition cost for each product. The company excels in areas of loan refinancing, personal banking, and wealth management. Recently, it has been under some selling pressure due to the student loan moratorium, and with that went most of the gains throughout the bullish period. However, it should be mentioned that despite the challenging environment of the economies around the world, it is not just bad news for the financial institutions like SOFI. So, for example, people are more aware of the financial fees when times are tough, and many are looking for alternatives to solve this issue. And SOFI might be one of the companies that can satisfy this need for better and lower fees. This might be one of the reasons why, despite having a challenging investing environment, SOFI still managed to see its customers' deposit amount increasing. Another factor to consider is the ongoing quantitative tightening and inflation. When inflation is high due to external reasons, interest rates tend to go up, increasing the bank's profit and decreasing the risk. After all, the purpose of a bank is to make money for the customers with the deposits, and the current environment allows SOFI to do just that. Overall, SOFI has been growing on a year-to-year basis, although the progress has slowed down in the recent month. This might be caused by the economic downturn, putting pressure on all businesses. Despite the unfavorable headwind, the fact that they still manage to grow is a testament of how their brand recognition and attraction has been promising on potential customers. Due to the regulatory and economic reasons, SoFi saw the student loan and home loan amounts decreasing by 51% and 73%, but this has been compensated by the fact that the personal loans increased by 71%, resulting in an overall increase of lending amount on a year-to-year basis. The long-term stock performance of SoFi is like every single other major stock listed on Nasdaq, which is disappointing. The stock went down by more than 70% since the beginning of the year, mainly caused by the moratorium of student loan, which is expected to resume in 2023, so we shall see whether this can bring the stock back up a little. Also, what brings SoFi down, and arguably keeps it down, is that it's a small boat in the ocean of recession. The Nasdaq, like any other major indexes around the world, have now lost most of the gains made during 2020 and 2022. This means that whatever that is ahead of us might only be the beginning of something and certainly not the end. This suggests that the market has come back from the predictions by the end of 2019 regarding the world economy, which was already anticipating for recessions, but without the worries and inflations and armed conflicts. This is why the probability of entering in a recession that might be worse than what we were talking about back in 2019 and beyond is high, which can bring the valuation of many securities, but especially equity for growth companies, down. So what lies ahead for SoFi is the possibility of a partial recovery of student loan business and a market-wide pressure due to the economic weaknesses and recessions. With that being said, because SoFi fell so much compared to the rest of the market, I honestly don't believe that there is much room to fall even further. Now, let's also take a look at the company's financials and see what the numbers can tell us. Regarding the profitability, they have a net loss from the operations, which is caused by the non-cash transactions and the non-operating expenses. On the other hand, SoFi yields positive gross profit that grows across the past few quarters, which is definitely something that is very encouraging and shows the validity as well as scalability of its business model. The one challenge that SoFi should address is the cost control, especially when it comes to operating cost. Now, I do expect the spendings to be eventually under control, but for the time being, I believe that SoFi will continue to emphasize growth and not the bottom line. Another aspect that is very important is leverage. Obviously, SoFi being in the finance sector, they have a relatively high level of leverage in the absolutes. However, compared to the rest of the industry, this might be normal practice. We should be aware, however, that the current level of debt can cause issues down the road, which is already showing in the diminishing part of the equity. A third aspect to look at would be the cash flows from the operations, and so far it seems like SoFi has been doing a decent job. The free cash flow as well as the cash flow from operations are positive, meaning that the company is self-sustaining in terms of cash reserves, bringing down the possibility of additional dilutions. When we take a look at the company's ratios, it's not hard to see that SoFi has been lagging behind in its valuation. This means that the company is not growing as fast as it should be, or using its assets as efficient as it can be, which is normal given the unfavorable market conditions. Regarding the company's profitability ratios, the numbers suggest that things are being stabilized and that from some perspectives, they might have already broken even. So overall, I would say that 2023 opens with a lot of promise, and hopefully in the subsequent quarters, we can see better numbers coming out from their financial support. Now, let's also take a look at the shareholder composition, as this can tell us whether the stock is molded for trading or investing, as well as the volatility of the stock. SoFi is owned by institutions for up to 36% of the current float, which is significant, but also showing that the vast majority of the shareholders remain retail. This also suggests that SoFi will be fairly volatile, with a great number of its shareholders trading in and out of positions based on rumors and short-term sentiments. With that being said, even with 36%, I believe that investing into SoFi is definitely a viable option. We should also point out that around 38% of the stock is owned by insiders, offering an additional layer of reassurance to shareholders. One key behavioral difference between the retail and the institutions is the investment horizon. Institutional shareholders can afford to wait longer and to sometimes wait for up to decades before seeing a company blossoming, whereas the retail shareholders want to wait maybe maximum a few months before they jump in and out of different stocks. Now, as far as the short sentiment goes, SOFI currently has around 12% of its volume that are shorting the company, with 2.4 days required to cover the short positions. That is a very significant amount of shares shorting to be sure. For the time being, however, I do believe that this is not a significant factor, or at least not the primary reason why you want to be buying or selling SOFI shares. I do believe that this is something to keep an eye on and something that we need to be aware of, because going further down the line, knowing that we have 12% of the volume shorting against the company, if it goes up, it might be amplified due to mass redemptions, and this can push the stock to even higher levels. So my analysis regarding SOFI is that I believe that SOFI is a company in which we should invest in the long run, meaning the short-term volatilities can provide us better entry points, but otherwise we should probably just ignore it. In the same time, I believe that the current price action is low enough for an initial entry and a confirmation that the current momentum is positive. The allocation should be done for the next 3 to 6 months.